India is lagging behind in the AI race.
In an era of artificial intelligence, natural stupidity hasn't gone away.
Given the size of the fund, which of course limits your capacity to invest in certain companies, should an investor expect the same level of returns?
Expect the same level of returns? Answer is very, very simple. Don't expect the same level of returns.
In the last 1 year, you have significantly increased stake in companies like Airtel and Mahindra.
Some of the sectors have undergone a consolidation where competitive intensity has come down and pricing power has come back. That's in the case of telecom. In the auto space, overall they have gone through a long period of low growth. And there are a lot of technology changes, product launches have happened from auto companies.
Do you feel regretful after you missed out on a multi-bagger because you maybe found it too expensive?
The worst sin to commit is envy, because while you commit that, you are miserable, and after that also you are miserable. If someone else made money in a company we did not understand, good for her or good for him.
What do you think will drive India's growth in the next decade?
Growth is very, very easy to identify. Money making opportunity, much more difficult.
Why such high cash holding, and do you see opportunities in the foreseeable future? Hi everyone, welcome to Power Talks. Today we have with us the person behind the biggest mutual fund in India, the one who leads more than 1 lakh crore of AUM. Rajeev Thakkar, the CIO and Director of Parag Parikh. Sir, I think first of all, it's an honor to have you, and as we were speaking about, right, Parag Parikh was my first investment, right? So this conversation is very special to me. And the reason I remember back in the day, I did not research that much, but I think there was this inherent trust in the brand, in you, that sort of made me do my first investment, and I still continue to hold that, of course. So in today's conversation, right, in the next 1 hour, while of course I will ask a lot of questions about the fund as an investor, but I also want to know, the person who is behind this, managing lakhs of crores of AUM. And what is your money mindset, right? How do you view investment and money? So let's start with, your early journey. I think when you started your career, right, after the Harshad Mehta boom, the market had just crashed. So did that impact you, as your fundamental philosophy of investment?
So at that time, while a boom and bust had happened, the graduation year was 92. The boom was happening when I was in the graduation year. Plan was clear to go for higher studies, to do chartered accountancy. But that was the era where we had gone through very tough times and we were coming out of the tough times. So the very tough times were was the Gulf War, where Iraq had invaded Kuwait, and then the entire war happened. Oil prices had shot up. We had a foreign exchange crisis. We had to pledge our gold to keep our country running. And then there was this liberalization where industrial licensing was abolished and things like that. So the FPIs, as they are now known, they were called FIIs at that time. They started coming in. So overall, the spirit of the time was financial markets are the place to be in. CCI was abolished. There was something called controller of capital issues, which would decide whether you could do a IPO or not, and they would determine the price at which the IPO would happen, not the investment bankers. So that was abolished. SEBI was given the power. So a lot of changes were happening in the financial system. So today a young person would want to join a startup. At that time, young people would want to join the financial markets.
Right, right. And then once you joined, the crash happened.
Crash had happened and recovery had also happened. So I joined an investment bank in 1994 as a trainee. The post 92 crash had happened and market had revived. IPO market had also revived at that time.
Okay, interesting, interesting. And you in fact started your career with fixed income, right? And only in, I think 2003 you moved to equity. Tell us more on that early journey of your, career.
So I started in investment banking. 94 to somewhere around 96, I was doing things like drafting the prospectuses for companies planning to go public, doing due diligence, keeping the records and things like that. More on the legal accounting side of things. Then for a couple of years or for 1 year I was in corporate finance, helping the company I was working for manage its borrowing profile in terms of financing from banks, NBFCs, fixed deposits, etc. After that, for a few years I was in government bonds. So at that time interest rates had gone up so dramatically. Government of India bonds were giving 14% per annum.
Oh.
AAA corporates like Tata Steel and L&T were borrowing at 18% per annum.
Oh, wow.
And AAA NBFC of that time, Reliance Capital, was raising money at 21% per annum.
Wow.
So interest rates were really high. So
was anyone investing in equity back then?
So that was a golden period for bonds and a very, very tough period for equities. So 1994, 1995 was when interest rates peaked at 14% for Government of India bonds, and then they kept falling, fell to as low as I believe 6.5% or 6% or thereabouts. So not only did people who buy those bonds get the 14% return, but the bonds appreciated in price. So you got capital gains as well.
So
that was an era when debt funds were giving 20% returns per annum.
Wow. And then what attracted you to equities back in the day?
So by the time we were in 2003, I could clearly see that the bonds had run their course. If you buy a bond at 14%, you are getting 14% interest.
Yeah.
Plus, if interest rates fall, you get additional price appreciation. If interest rates are already at 6, how much lower can the interest rates go? Plus, that 6 is not what you are getting. If you are investing via a fund, there will be an expense ratio against that. And if interest rates were to move up, you will get 6, but your bond price will dip. So your holding period return will be lower. And in 2003, well-run companies were giving dividend yields of 10% plus.
Oh, okay.
And that was again a period where long-term capital gains were made tax-free and dividend was tax-free.
Dividend was tax-free back then?
At that time.
Okay.
So internally we were having this discussion, and I mentioned this to our founder, Parag Parikh. He's no longer with us, but he saw merit in the reasoning, and he said, "You seem to be quite excited about equities. Would you want to move into equities?" I said, "I would love to." So that's when the transition happened.
Got it. And that's the start of the great era. And that I think 2003 to 7 was also a great run for the markets as well.
Absolutely.
Right?
So in 4 years, the markets at the index level went up 7x.
Wow, yeah, that's huge, right? And you could sort of capitalize on the wave. So very curious, back in the day, right? What was your investing style? Were you more aggressive, contrarian, or you have always been a value investor all throughout?
So my aggression was never there. So my approach was always to look at companies which gave good cash flow. So initially I was a low PE, high dividend yield kind of investor in my individual capacity. 2003 when I moved to equities full time, and even before that, I had the privilege of interacting with a few respected investors. So a person by the name Mr. Chandrakant Sampath, he would come to our office and guide analysts. So by that time I had started reading about Buffett, about Philip Fisher, the importance of paying slightly more and buying better quality companies. So that small shift happened, but I was never a aggressive investor as people normally understand it. Just go out and buy the company in fashion and things like that. That was never my style.
Yeah, I think that's still reflected in even the fund's philosophy. Like if you look at the PE for Parag Parikh versus category average, it's much lower. So, I think buying for the right value has been always core to your journey.
Yes.
So coming to the investment philosophy, right, I think you speak about 3 edges, the informational edge, analytical edge and behavioral edge. And I think behavioral edge is where you over-index. So would love to, pick your brains on what are some of the behavioral frameworks that you apply in your investment philosophy.
Sure. So this is not my original statement. Someone has said it. I don't remember the name to attribute. But the saying goes that in an era of artificial intelligence, natural stupidity hasn't gone away. Right? So people still make the same mistakes that they would make 300 years back or 400 years back.
Biases remain the same.
Biases remain the same.
I think we know this, right? Loss aversion, we know the recency bias, anchoring bias, but still we fall prey to this. How have you stayed so calm and consistent across the 3 decades that you have been in the industry?
So, if you depend on making the right decision in the heat of the moment, you will typically fall prey to the biases that are there. You will not arrive at the right decision. The preparatory work has to be done much in advance, and the environment, the systems have to be such that to the extent possible those biases are kept away. So, a simple thing like if you are reviewing your portfolio, just hide the cost column. If you are not aware of what price you have bought it and you only know the quantity and the current market price, arrive at your decision. Then maybe things you can review it. Are you selling it after 11 months and 15 days? Then you may wait 15 days more for it to become long term, or some of the things you may want to check out later on. But at the first instance, if you are not aware of the cost, then the loss aversion would go away.
Right.
For recency bias, in general, try and stay away from more frequent data.
Okay.
If you can shift from reading daily newspaper to a fortnightly news publication, that's better. If you can shift from quarterly earnings to annual reports, that is a big jump. People are too focused on getting high frequency data. That tends to be very, very noisy. When you look at the longer term data, that has more signaling effect.
Interesting. And sort of stemming to the investment philosophy, I was reading, I think the promoter is one of the very core sort of filters that you have in picking the right companies. Tell us more on that. What exactly do you look for? And have you sort of gone ahead and made any bet on something that didn't work out later?
Sure. So, in terms of first principles, when you buy an equity share, you are partnering with the promoter of that company. Now, that promoter can be a business family, it can be Government of India in case of PSUs, it can be a multinational corporation. Sometimes there are private equity owned companies, or some are completely publicly owned. But essentially, either you are depending on the business family or whoever is the promoter entity or the manager to deliver value for you, because you are not going to be running the company on a day-to-day basis. Now, no matter how good a horse is, if the jockey is bad, you are not going to win the race. So, you need, apart from a good business, you need a good promoter or a manager in place. So, how do you define good? One is the person should be competent, or the team should be competent. They should have integrity and they should have energy to deliver. If these are missing, then things become very, very challenging, and honesty is, the integrity is the most important part, because otherwise they will use their brilliance and their hard work in cheating you out of your money.
So personally speaking, I'm sure you also talk about it, right? There could be cases where you maybe missed out on a multi-bagger because you maybe found it too expensive. Do you feel regretful after that?
So, Charlie Munger was very fond of saying this. He said the worst sin to commit, and there are these 7 deadly sins in the Western concept, says the worst sin to commit is envy. Because while you commit that, you are miserable, and after that also you are miserable. So, long term consequences of all sins are negative, but envy, you are miserable even while committing it. So, if you are very, very rich and I am not, or if you found a multi-bagger, I did not, and I start envying you, then I feel miserable because she made so much money in that stock and I did not. Other sins, at least while you are committing them, it's pleasurable. So, if we indulge in gluttony, if we have a lavish feast and we overeat, it's enjoyable while we are committing it.
It's nice.
In the moment. Later on, there will be bad consequences, but in the moment, it's nice. Later on, anyway, all sins have negative consequences. But envy is something we try and stay away from. If someone else made money in a company we did not understand, good for her or good for him. Why should we lose our sleep or be resentful? We get our fair share of good investments.
Yeah. No, I love how comfortable you are in your, mindset, not like just that blocking that noise is so important, especially in today's time. And I think that's what sort of drives the stability in the fund itself. And I'll jump to the fund, now, because the fund has given 19% returns annually since inception. It's beaten benchmark 8 out of the last 10 years, right? Doing exceptionally, and of course, 1.2 lakh crores of AUM. As an investor myself, right, there are certain questions I have regarding how do you approach now the fund given its big size. So the first question and the biggest one that I have is given the size of the fund, it's so huge, which of course limits your capacity to invest in certain companies. Should one as an investor expect the same level of returns going ahead?
Expect the same level of returns? Answer is very, very simple. Don't expect the same level of returns. Firstly, equities are not guaranteed return products. They are market determined. They go up and down. Also, historically, equity indices have given somewhere around 15% returns per annum. A large part of it is of an era when interest rates were very, very high, when inflation was very, very high. Today, when interest rates, inflation are much lower, nominal growth will be lower, even though real terms we may be growing the same rate. So, nominal equity returns also should logically be lower. So, I would not recommend anyone to come in to equity investing in our fund or anywhere else expecting very, very high returns. Today, when let us say bonds and bank FDs are giving anywhere 6.5%, 7.5% kind of returns, when people come to equities, people should expect somewhere around low double digit returns as a asset class.
11,
where is 10, 11, 12 maybe. Where is this number coming from? Essentially the nominal GDP growth rate of India. If we grow at 6.5% and if we have a 3.5% inflation rate, that is 10%. If we have a 4.5% inflation rate, it will be 11%. Corporate earnings will more or less be somewhere in that vicinity, I would think. But still it is much higher than your bank FDs. So, over long term compounding, obviously the impact on the investor's wealth will be significant.
Right.
But equity as an asset class is not suitable for short to medium term goals. So, that has to be kept in mind. I do not think people should come in with 19% return expectation.
Right. So, I think my understanding is, while not looking at the absolute number, like in terms of percentage returns, but it's just given the inflation is much lower now, you are still able to buy the products, right, given how the inflation is. So, it still sort of counters for your buying capacity, and I think that is the fair expectation of 10 to 11, 12%.
Yeah. So, that is the return part of your question. 10, 11% is reasonably good return. It beats inflation. 10% is a very, very decent return. There could be periods where returns are lower as well. So again, 10% is also not guaranteed. I mentioned at the beginning of my career, 1992 to 2003, 11-year period, we had negative returns at the index level, 4,200 to 2850. That was the index movement.
Yeah.
The second part of your question, size of our assets. HDFC AMC just reported its numbers. They have assets, equity, if memory serves me right, they have around 5.5 lakh crores of assets. So we are still much smaller than the larger fund houses in the country. We rank at somewhere about number 15, so there are 14 AMCs much larger than us. Equity market itself has grown quite a bit. So today the growth has been so much that a company with a market cap of 30,000 crores gets classified as a small cap company. Now a 30,000 crore market cap company, one would think, is quite large. So overall market also has grown. Of course, very, very tiny companies, it becomes challenging to invest in those. But otherwise, there's ample opportunity in the overall market for us to be able to invest.
Got it, got it. So coming to, I usually divide it into three parts, like the allocation, how the fund is allocating to large, mid, small. Second is the stock selection, and the third is the overall themes that you take bets on. So in the allocation part, right, I have observed Parag Parikh taking a lot of exposure in large cap, which is quite contrary. I mean, a lot of people now are, taking more and more exposure to mid and small cap. And I think for mid and small cap pre-COVID, while I think Parag Parikh was around 20-25%, it's very low right now, 6-7%. So what makes you, bullish on large caps in today's time?
So when we start looking at a company, the starting point is not will it get classified as large cap, mid cap or small cap. Is this company having a business which we like? Do they have some pricing power? Do they have some right to win in their product categories where they will grow in line with the market or faster? Is the balance sheet proper? Are the return on capital ratios proper? Is the management quality good? All those factors. It may happen to be a large cap, it may happen to be a small cap or a mid cap. In recent times, the run up has been far steeper in the small and mid cap space. So it so happens that the opportunities that we get are coming more in the large cap space. Otherwise, we have been buying even in the small cap space. So just yesterday we had a block deal, we bought something in a small cap stock. A while back we bought maybe 8-9% of a company in a small cap space. So we have been buying across the board. It's just that opportunities have been coming more in the large cap space purely on a valuation basis. This thing that people have, that the smaller the company, the higher the return you will make, that is to my mind a very, very big mistake. Look at the US markets over the last few years. Almost all the returns have come from the large 7 to 10 companies. Rest of the market has not done much. So it's not a law of physics that you go into small cap, the return will be higher than mid cap, and mid cap return will be higher than large cap. That is not the case. These things go through cycles. There are periods when small caps do better. There are periods when large caps do better. We try and invest where we find opportunities.
Got it, got it. No, even actually what you said, that this whole concept, like I would say misconception around ki, mid small will give you more alpha compared to any large cap. I think US market is a good example. But given that is more technology stock, right? How I would think intuitively is, given the base is so huge for some of the large cap companies in India, right? The growth will only be, of a limited size, while the potential is much higher for the smaller companies. What's your take?
Let's go back, let's say 10-15 years back. Which would be the large cap banks then? Which would be the small cap banks then?
I mean, as
HDFC
SBI,
Bank would be a large cap bank 10 years back.
Yeah.
Right? And a bucket of small cap banks, no particular view on any of these, but let's say Karur Vaisya Bank, Catholic Syrian Bank, DCB Bank, take any small cap banks, which segment would have done better for investors over the last 10 years? HDFC Bank would have done it. Right. IT services, of late, smaller companies have done well, things like Persistent and all have done well, and we invested in those when we felt the opportunity was right. But there were periods where most of the business was going to large cap IT. In recent times, it's been the case that small cap IT or mid cap IT has done relatively better than large cap. But these things go through cycles. There's no universal thing that only this space will do well or that space will do well.
Right, right. So basically, you're looking for the right valuation, irrespective of whatever
right
is the
valuation,
size
right business, right management team.
Right. As we were talking about allocations across large, mid, small, there's been this whole thing about mid and small cap still being overvalued.
So broadly, if you look at the flows that have been coming to different categories of mutual funds, the flows in small caps and mid caps have been elevated. Mid cap is only 150 companies, and small cap, although the number of companies is 250 plus, even below the small cap, the micro caps, etc. In theory, they can invest in a lot of companies, but the investable pool is not that large. Considering the investment pool, the fund flow coming to these market cap specific categories, that has been disproportionate. So, like it does not logically make sense for mid cap schemes and small cap schemes to have corpuses which are similar to large cap schemes, or to get flows which are similar to large cap schemes. If we look at the profit pool of corporate India, about 70-75% of the profit pool would be the top 100 companies, or one would like there to be equal opportunity for all companies, but the reality of the business world is that the most successful companies earn bulk of the profits.
Yeah.
In such a scenario, spreading your money equally across all the categories may not be very helpful.
Right.
Individual opportunities may be there here and there, but broadly the categories have been victims of their own success. Their past performance has given them a lot more money to manage, and consequently opportunities have been hard to come by in those places.
So are there certain valuation points that you're looking at, maybe like a 10% correction or something, which will give you the right sort of segue to enter into and sort of increase your stake like it was back in 2020, 21?
It will be individual names end of the day. So if we get a good individual company, irrespective of the overall market, we could deploy, let's say, 2,000 or 3,000 crore in a small cap company,
right,
and take up a 10% allocation there.
Got it.
So
actually, on that point, because you mentioned this example of taking up 10% allocation, given the fund size is huge, right? Because right now the fund is pretty concentrated around 40-50 stocks. Given now the higher size of deployment, one strategy is to take bigger stakes, or second is to just take micro stakes but in a lot of companies. Is there a particular preference that you are seeing going forward?
Sure. So in the large and mid cap space, there is absolutely no challenge in terms of having a reasonably concentrated portfolio.
Okay.
So we can still run a 25-30 stock portfolio across the large and mid cap space and be very, very comfortable. In the smaller companies, we will have a slightly larger number of companies, but we are not looking at having hundreds of stocks in that space, but we could have a slightly higher number of companies in the small cap space.
Got it. And that brings me to my next question, right? In your fact sheet, right, there's 35% allocated to debt and others, which I would assume includes 20% of cash that you're also sitting on.
Around 24% or thereabouts cash.
Yeah. So, why such high cash holding, and do you see opportunities in the foreseeable future, and that's where you are waiting for?
So cash has been the best performing stock, right? Last 1 year.
It is.
So that gives you 5.5, 6.5. Interest rates have come down to 5.5, but money market rates were somewhat higher a while back. So it's not any decision that we make saying we want to keep this much in cash. We buy whatever we like. Whatever remains goes into money market investments. So roughly 11% is in overseas stocks. Yeah, roughly 65% is Indian equity, of which a little bit would be arbitrage. Balance is cash and money market.
Right.
A very tiny amount in REITs is there.
Got it.
So even things that we like, there's a certain target weight that we have in mind for the portfolio at the individual company level and at the sector level. We cannot endlessly buy one particular stock. So let's say we have internally kept banking weightage at, let's say, 20%. Now we will not endlessly buy banks even though we think they are reasonably attractively valued. In pharma, if our comfort is to have, let's say, a 5% allocation to the sector, and if we are there, then we may not endlessly buy pharma companies. So whatever is left goes into money market investments.
Right. So is there some point in valuation that you're looking at that, once the market hits that level, that is where you will start deploying that cash?
It's not linked to market valuation, it's linked to individual company valuations. So in every overheated market in the past as well, there have been pockets of excesses, there have been pockets of attractive valuations. So late 90s, where all the tech companies were doing well, that was called the dot-com boom. What was called old economy, so the consumer good companies, the pharma companies, all those were reasonably valued. 2007, the boom was in real estate, commodities and infra related companies. This time actually IT services were reasonably valued as compared to the previous bull run of late 90s. Again, consumer good companies, pharma companies, all those were reasonably valued. This time around the boom has been more on the consumption side. So anything to do with retailing, anything to do with domestic consumption, so or some select themes like defense, etc. have been in favor, and people have been over allocating to those spaces. So we tend to look at spaces which are more reasonably valued, which are attractive. So we are not looking at any particular index level or any particular market valuation to buy. In fact, last 1 year, people may think we have been sitting on 24% and doing nothing. In last 1 year, we have bought and sold quite a few companies. It's just that at the net level, it so happens that cash levels have been in that range.
Right, right. And because you bring this point of, buying, selling a few stocks, and I was observing, right, I found two key observations here. One is that in the last 1 year, you have significantly increased stake in companies like Airtel and Mahindra, right? What's the reason behind this? Are you bullish on the sector overall? What's your view?
Some of the sectors have undergone a consolidation, and where competitive intensity has come down and pricing power has come back. That's in the case of telecom. In the auto space, overall they have gone through a long period of low growth, and there are a lot of technology changes, increased the prices for some time. There was this threat of Chinese EVs coming to the market, which has subsided. A lot of the product launches have happened from auto companies. So largely based on these things, we of course have our annual unit holders meeting coming up, where we will discuss the individual rationales around the companies that we have invested in.
Right. And what's the approach like? Do you approach it sector first or like company first? Like for example, is it the balance sheet and the valuation that makes that more attractive, or the sector itself? How do you think about it?
Both matter. So unless you have an understanding of a sector, you will not be able to understand the business of a company. But end of the day, within the same sector, there could be two very, very different business models. And one business model may be attractive, whereas some other business model may not be attractive. So let's take a very, very vivid example. These companies are not listed in India, but let us say someone runs a fleet of cars for hire versus a company like Uber, which creates an app and matches drivers and riders. Now, Uber, at least in theory, is asset light, can have potential to make high return on capital and scale and things like that, whereas the other one is a asset heavy business, depending too much on utilization and things like that. So within the same sector, which is transportation, you could have very, very different business models. So individual company definitely matters a lot, but you need some understanding of the way the sector works and the dynamics at play over there.
Right. So apart from telecom and auto, where we do see you taking, like Parag Parikh taking positions, are there other sectors where you feel bullish for the next 5-10 years?
So our fact sheet is in the public domain. So we have 11% investments in the overseas companies, the big companies which are on the right side of various trends, linear TV to streaming, traditional advertising to digital advertising, on-premise computing to cloud computing, physical stores to e-commerce, Gen AI. So these are on the right side of all of these trends. So that is where we have invested in. We have a small allocation to generic pharma. We have about 20% allocation to the banking sector. We have some allocation to telecom. We own 2 auto companies. We own a conglomerate which is into financial services as well as the two-wheeler space. It's a fair mix of different kind of companies.
Can you walk us through a little bit about what's your selection framework? Like, what are the 2-3 things that you look at, as checklist?
So combination of promoter and management quality, combination of the business characteristics, the balance sheet of the company, and finally the entry valuation. So
Got
these
it.
things.
Got it. And another observation that I saw, we spoke about the 2 companies where you increased stake. There was also Motilal where you exited completely, and it was a big 2% stake. While you remain bullish on the overall banking sector, like what was the rationale behind it? Just curious.
So overall, we have reduced our exposure to the entire capital market space.
Okay, and why?
So we used to own a asset management company. We used to own the wealth asset and stock brokerage company. We had investments in the exchanges, the commodity exchange, the depository. We had a stake in one of the RTAs. So we had a mix of various investments over there. Longer term, capital markets are a growth business, but they go through very, very severe cycles. So the time when we bought these businesses, these were at very, very low or distressed valuations. Now they are getting reasonable valuations on arguably cyclically high earnings.
Okay.
So let's say stockbrokers, for example, you would have seen the founder of one of the unlisted discount brokers on social media talk about this, that their business could be down maybe 30-40%. We have seen the pushback on the near-term expiry contracts and the volumes over there. So the number of contracts have been reduced over there. That has impacted some volume. So also in the sideways markets, volume tends to come down. In a downward market, it comes down even more. So it's basically a view on the sector that near term or medium term things could be a bit difficult in the capital market space. Also the space doing well for a few years brings in more players. So whether you look at stock brokerage, whether you look at asset management companies, whether you look at wealth management,
Yeah.
more and more players have entered the market.
Yes.
What that does is it increases the talent cost for the incumbents and everybody else in the system. So, people just shuffle around and higher salaries have to be paid. There is a competition on the revenue that you can charge the end customer. So, fees come down. This itself is a huge margin pressure. And when existing business gets fragmented among more players, volume per player comes down, and then if the overall cycle turns downwards, then things can be very, very tricky for
Right.
players in the space.
Right. Interesting. Interesting. And the other aspect of allocation that we spoke about, 11% to the overseas market, and I think you have also been one of the very early players to be investing in US tech stocks, right? Back in the day, I think 2021, this exposure was as high as 28-30%, which is now 11%. Why is that the case? Is that a function of the AUM?
It's a function of restrictions on remittance of funds abroad. So, the $7 billion limit, which was set way back, if I am not mistaken, in 2008 or 2009 somewhere, that hasn't increased after so many years. So, the mutual fund industry.
Do you think it's due for correction now? Like
I would think so. I would think so. Yes. So, the mutual fund as a whole, all the mutual funds put together have hit that $7 billion limit. So, we cannot remit more money out. As a consequence, all the incremental money that we get gets invested in domestic stocks.
Yeah.
So, the weightage to foreign stocks comes down over a period of time.
Correct. So, consequently, my question as an investor is, ever since inception, right, the 19% annualized returns, they also came as a function of great growth that also happened in the US market and the alphas that they delivered. Now that that is restricted, and US is going through the AI wave, NVIDIA, all of these, right? How do we ensure like we are still sort of having exposure to those kinds of alpha that tech can deliver? Any way around for that?
Sure. So, talking about ourselves, our Indian returns and foreign returns haven't been that significantly different. So, we have another scheme running, which is the tax saver fund, where the Indian stocks are more or less common. There would be small differences, but that scheme does not have any foreign stock exposure. That has also been able to deliver reasonably good returns. So, all along we have said that reason to invest abroad is to lower the country specific risk rather than necessarily get higher returns.
Okay.
So, let us say the India-Pakistan conflict that came about, it is a India specific thing. It will affect the global markets, but not to that extent. So, when you have a mix of India plus overseas exposure, it reduces the portfolio risk and volatility. How to take exposure? So, while mutual funds are restricted, individuals are free to invest abroad. They have to use something called the liberalized remittance scheme of RBI, convert their rupees to dollars and invest abroad. People could do it on their own, or there are a lot of asset management companies setting up in Gift City to offer funds and portfolio management services from there. So, apart from others, we have also set up a Gift City entity for this purpose.
Okay, okay. And the whole US tech stocks and the AI thing always raises this question in mind. Do you think like India is lagging behind in the AI race, and given AI is the next big thing, where do you see the India's growth story for the next 5-10 years?
So, some of the biggest users of these AI platforms are in India. So, companies give out this information, how many users by which country. So, India ranks right up there.
We are 1 billion plus people. So,
and a lot of people with technology smarts in that sense. I am not that pessimistic about the whole AI taking away all the coding jobs and things like that. Okay, we have not been at the forefront of developing these models like ChatGPT or Gemini or DeepSeek or those kind of things. But we are very efficient users of the models that are there. I think that itself is a big opportunity in terms of transforming various workflows, integrating those newer AI tools in the way work is done, improving efficiencies, doing things that were earlier not possible. I think it's very, very early days and there will be a long journey and we will participate in that. Developing a model from scratch is a very, very expensive proposition and there are many open source models also out there, in which case you need not reinvent the wheel. Whatever is already out there, you could put that to work. Let me flip the question a bit. India has never developed its own operating system like Windows or Mac OS. Has that stopped our IT progress? No. So, even if the models are developed in some other country, you can use those models to improve productivity.
Right, right. And given we are talking about, the themes or like sectors for the India's growth story, do you think new age sectors like quick commerce or like what do you think will drive India's growth in the next decade?
Again, two parts to this. Growth is very, very easy to identify. Money making opportunity, much more difficult. So, Benjamin Graham many decades ago said this in his book. Obvious prospects for physical growth do not translate into obvious profits for investors. To your question, is quick commerce a huge growth opportunity? Answer is undoubtedly yes. Has that been a very, very profitable operation so far? On the reported numbers, it doesn't show great profits. Like if your reported profits are lower than your other income, obviously it's in the investment phase, it's not in the mature phase. As a fund house, as a organization, we are at the more mature end of the investing spectrum. So, did we invest in a startup Google or Amazon? Answer is no. We invested in those companies when they started generating cash flows. So, lot of companies will grow. Quick commerce is growing, providing enormous convenience to its customers, creating employment for gig workers. What's there not to like about it? Will we invest? When will we invest? We'll see when the cash flow generation starts and when the valuation is attractive. Maybe at some day.
Right. I think interesting case in point of this philosophy, because it's often said, you should get in early to generate great returns, but you have gotten in for most of the companies at a more mature stage and still able to deliver 19%, which essentially sort of brings me to the conclusion, ultimately it's mean reversion to how the business is sort of growing at the end of the day.
So, when you get in early, mortality is very, very high. If in 90s where Indian Airlines had a monopoly on domestic civil aviation, the sector was opened up for private sector airlines. Would it make sense to be early and invest in the early airlines? None of those companies exist today, not a single one of them. Indigo was not among the early players. So, we are more into cash flow generating businesses kind of thing. So, that's a choice that we have made.
Right. On that note, sir, what is your personal investment philosophy? Like, what does your personal portfolio look like?
It's largely in the schemes that we run. It's far more equity heavy than what would be considered sane by most people. It's happened by accident. So, luckily savings rates have been reasonably high. So, even the small debt allocation that is there is sufficient for regular needs. So, that's why it does not bother me so much, but largely it's in these schemes that we run.
Got it. And do you also have exposure to, you said a little bit of debt, but like gold, silver, which are like the current talk of the town?
Those are in variable form. So, I see the gold in the house in family weddings and as a, or the small amount of gold bought on auspicious days, so Dhanteras or something like that. But other than that, nothing significant.
Okay, okay. So do you have like your favorite asset class? Is anything beside equity?
REITs make sense, which gives a blend of regular cash flow plus capital appreciation opportunities.
Got it, got it. So I think final note, sir, like our audience for context is this 35-year-old who is on their journey for long-term wealth creation. And as someone who has been in this industry for three decades, right, helping a lot of people create long-term wealth, what's your advice to them on how should they go about staying in the market?
One is stay the course, so don't expect annual returns from equities. There could be half a decade where nothing happens, there could be a decade where nothing happens. Don't get into the temptation of tinkering with asset allocation too frequently. And second is have some equity corpus, have some emergency corpus. So the mistakes that I see is people either are too conservative, well they'll put all the money in bank FDs, or they become too aggressive saying YOLO, everything in equities, nothing else. So people who did that had a tough time in a period like COVID. Now, they did not want to sell at the COVID lows, but some people had job losses, etc. And if they did not have an emergency corpus, they were forced to dip into equities at the wrong time.
Right. Makes sense, makes sense. And anything about money mindset that you would sort of end this podcast on as a guidance to all of us?
So I think spend money. So very interesting book has recently been published, The Art of Spending Money by Morgan Housel. So spend money on things that make you happy, but don't get into the trap of spending money to impress other people, because that's a game one cannot win, and that's at least to my mind, a very wrong way of approaching life.
Right, right. Now I think perfect note to end this conversation, sir. Thank you so much for taking out the time. I learned so much, and as an investor now I am much more aware of what I am investing in. So thank you so much for sharing all these insights.
Thank you for the opportunity.